plans, strategies, and implications for independent lenders. My name is Kurt Blum from Richey May Advisory Services, and before we dive into today's presentation, I just want to go over a few housekeeping items. First, for optimal audio, all the participants' phones will be muted during the presentation. We will have a Q&A session at the end, and we do encourage your questions. You can submit a question at any time during the presentation by using the question box feature, and at the end of the presentation, we will go ahead and answer your questions. We will also be posting the presentation to our website afterwards, as well as emailing the slide deck to all the participants on the call today. And thirdly, for CPE, if you've signed up for CPE, there are a few requirements that must be met in order for you to qualify and receive your CPA or CPE certification. First, there's going to be 3 polling questions. They do all have to be answered. They don't have to be necessarily correct, but they do have to be answered. And then at the end of the survey, or at the end of the presentation, a survey will be provided that will be required. So please don't exit the webinar as it'll pop up at the end. And then after the survey and all the polling questions, the CPE certificates will be emailed within a few days. So I'd like to introduce today's speakers, Jared Kloss and Keith May. Jared is a tax partner who has been with Richey May since 2009. Jared has 14 years in the industry and specializes in providing tax compliance and consulting services to mortgage banking companies throughout the United States. Keith is the founding partner of Richey May, who currently serves as the partner in charge of the Richey May's advisory service practice. Keith has over 35 years in public accounting, providing consulting and assurance services to a broad range of public and private companies, included mortgage banking companies, financial institution, and financial services firms. So with that, and so that we can dive right into today's material, we'll now turn it over to Keith and Jared.
Okay, thanks, Kurt. So in the next 45 minutes or so, we're going to talk about the following topics. So what is a deferred compensation plan? We'll talk a little bit about the different types of plans, various strategies involved in deferred compensation plan, and then we'll go in and talk about the accounting for deferred compensation plans, and then the tax treatment of deferred compensation plans. So what is a deferred compensation plan? Fairly easily, any plan where compensation is earned in one period and paid in another. So basically, just as it says, a deferred compensation plan. What are some of the main reasons for deferred comp plans? The first one is basically additional compensation to management and employees over and above their base salary, whether that be for performance, for sharing company profitability, or to reward them for sticking around with the company. So second reason is employee retention. So to retain employees by using some sort of vesting schedule to where compensation vests over a period of time. Third, to reward employees for retirement. And then finally, tax deferral for employees. So types of deferred compensation plans. So we usually break them down between qualified plans and non-qualified plans. Qualified plans would include defined contribution plans such as 401ks, defined benefit pension plans, profit sharing plans, other post-retirement benefit plans, and also it would include incentive stock option plans. Non-qualified plans include just your basic compensation structures such as commissions, bonuses, stock appreciation rights, which are similar to stock options, but instead of an exercise price, there isn't an exercise price, and you're just paying for the amount that the stock appreciates. Phantom stock plans, where you're calculating value based upon some formula or tracking some value that reflects the value of the company itself or a division within the company. Non-qualified stock options, which would be similar to incentive stock options, or just not under a qualified plan. Restricted and unrestricted stock awards, where you're actually awarding actual common stock to employees. And then finally, under the other category, I mean, all other deferred compensation plans, and those are really limited only by the creativity of the designers of the plan. It can take on various different structures, terms, time periods. So it's a very flexible structure to design a non-qualified deferred compensation plan. So with that, we're going to go to our first polling question, and you should shortly on the screen have your questions. So, and the question is, do you currently have any of these deferred compensation arrangements? And either ping in as yes or as no. We'll give everybody a couple seconds to make their answer. All right, great. Thanks, everyone. And with that, I'm going to turn it over to Jared. He's going to talk about some of the strategies involved in deferred compensation plans.
All right, thanks, Keith. So strategies for deferred comp. You know, there's obviously lots of different reasons why you might use a deferred comp arrangement, but I've tried to boil it down here into kind of three main reasons why companies are using deferred comp plans or arrangements. So the first is reward. This would be, I mean, and there's obviously lots of overlap here between the three strategies. You know, you might have a deferred comp plan that accomplishes more than one of these, but when I think of reward, I think of your typical kind of year-end bonus, where, you know, you might be paying for performance in the prior year, but, you know, which would technically mean that it was earned in that prior year, but maybe payment isn't occurring until the current year. So, for example, a 2015 bonus might be based on performance that occurred in 2015, but maybe payment doesn't occur until sometime earlier or later into 2016. Often these type of reward structures are paid within a short period of time after the year end, and if they're within the 2.5 month short-term deferral rule, which I'll talk about when I go through the tax implications of deferred comp plans, then there really isn't any issue from a tax perspective, at least. So that's kind of when I'm talking about reward. And that's, you know, a lot of people are already doing this. I mean, year-end bonuses and commission structures are pretty common, especially within the mortgage banking industry. That's a pretty typical structure that we see. Well, we're finding more and more of our clients and more people in the industry using deferred comp plans to try and accomplish our around retention strategies and retirement. So retention strategy, obviously, it would provide additional compensation to an employee who stays with the company for some specified period of time. So if you're trying to retain an employee for, say, 5 years, there might be a way to structure some sort of deferred comp arrangement where there's some cash or other property that's available, that will be made available to them 5 years from now if they stay employed with the company during that time. So common examples of this would be, you know, stock options or SARs, as Keith was talking about, stock appreciation rights, or there's various other non-qualified deferred comp strategies that might be in place. For example, you could say, hey, I'm going to put $50,000 aside, and if you stay with the company for 5 years, then you're entitled to payment of that $50,000. That would obviously be a very simple deferred comp arrangement. Stock options and SARs, obviously you could have a similar thing where they're granted an option today, but they don't have the right to exercise that option for 3 or 5 years, depending on how long you want them to stick around, at which time they have the ability to exercise that option and could reap the benefits of any appreciation in the value of the company during that time. So those are kind of some common retention strategies that are used by our clients and others in the industry. So for retirement, obviously you have your, you know, most companies have a 401k plan or some other type of qualified retirement plan already in place, but often there's limits on the amount of compensation that can be deferred in those plans. And so a lot of times what loan officers or other key executives of our mortgage companies are looking for are strategies or ways that they can defer more of their income for retirement. And so there's methodologies that can be used to use a non-deferred compensation plan that allows them to set aside more of their earnings. They basically stay with the company and they're subject to creditor risk, unlike qualified plans like a 401k. But by setting it aside into a non-qualified deferred comp plan, the employee is able to take advantage of the tax deferral on that money that's set aside in those plans. So again, just to kind of recap, reward, retention, retirement, those are kind of the three main strategies that we're seeing our clients use non-qualified deferred comp plans and qualified deferred comp plans to try and accomplish. With that, the other thing that we wanted to talk about on this webinar besides strategies was to make sure that our clients understood the compliance issues that are associated with deferred comp plans as it relates to GAAP accounting and tax treatment. So with that, I'm going to turn it back over to Keith, and he's going to go through GAAP accounting for deferred comp plans.
Great, thanks, Jared. So I'm going to go over some of the basic accounting requirements so you can understand what the impact of the accounting is going to be when you go through and design your compensation plan. So, if you look at the Accounting Standards Codification, this is where you're going to find the accounting requirements for different types of compensation. So Topic 710 is basically compensation in general. In Topic 712, you're going to find non-retirement post-employment benefits. 715 is retirement benefits, and then finally 718 is stock compensation, both equity and liability, and it's really where I'm going to spend most of my time. Retirement benefits, we could probably spend the whole day talking about the accounting and disclosure requirements for defined benefit plans. Defined contribution plan accounting is fairly straightforward. Basically, whenever you determine what the company's contribution for the year is or what their match, it's going to be accrued at that point in time. So I'm really going to talk mostly about compensation plans, deferred compensation plans, and mostly about non-qualified plans from an accounting standpoint. So really the first issue is making the determination as to whether the plan is going to obtain equity or liability classification. And that's important as to where it's going to end up on your balance sheet. Is it going to go through the equity section, or is it going to end up on the balance sheet as a liability? So that determination is really based upon the award's substantive terms, the award's repurchase features, and then the award conditions other than service. So if there's any performance or market conditions going through and making those determinations. So the general rule is if the award is going to be settled by issuing common shares, it's going to qualify as equity. If the award can be settled in cash at the employee's election, it's going to be treated as a liability. So that's the main distinction as to whether the company can settle using their own common stock, or whether the employee it's going to be settled in the cash, or the employee has the option to have it settled as cash. So, and the importance of that is, under an equity award, your measurement date is going to be the grant date. So whatever the date the stock award is granted, that's when you're going to determine the fair value that determines the compensation costs. And then that value is going to remain fixed throughout the term of the agreement unless there's some sort of modification to the agreement. So, and then finally, the compensation cost is going to be recognized over the requisite service period. So the advantage of an equity award is two things. It's going to run through equity, and then the compensation cost is only going to be calculated once at the beginning of the award at the grant date, and then you're going to spread that compensation cost over the service period. For a liability award, the measurement date is actually the settlement date. So you're going to go through and measure fair value at the grant date, and then every period thereafter, you're going to remeasure it until the award is settled. So ultimately, the expenses and liability is going to equal what is actually paid at settlement. So the compensation cost is going to be recognized over the service period, with any changes in fair value each reporting period being recorded as a cumulative catch-up adjustment to compensation each period. So the disadvantage with a liability award is you're going to have to keep remeasuring each year and running the catch-up adjustment of the fair value through the P&L each year. So, your compensation could increase if the value of the award increases over a period of time. Plus, you could get some volatility as the fair value goes up and down year to year. All right, so equity awards, there's some special rules for non-public companies. So for equity awards, you're going to measure them using fair value. So fair value is going to be based on probably some type of option model, such as Black-Scholes. And for non-public companies, you're going to measure volatility by looking at similar public companies and what their volatility is. For liability awards, non-public companies can elect fair value or intrinsic value. So fair value is just what we discussed, using some sort of option model to determine what the fair value is, or you can elect to use intrinsic value, and that's the amount by which the fair value of the underlying common stock exceeds the exercise price. So you're still having to go through and determine the fair value of the company or the common stock. You just don't have to use an option model if you're electing that intrinsic value election. All right, so let's talk a little bit about the service period. So you're going to recognize compensation costs over the service period. So, and the service periods are going to be determined based upon the terms of the agreement. So you're going to go through, read the agreement, and you can either have an explicit service period or an implicit service period. So an explicit service period is where it's actually stated in the agreement, where it says this award is dependent on 5 years of continuous service. An implicit period is when you're having to meet some sort of market component or performance component, such as an estimated fair value target for the company. So you're going to have to go through and estimate the service period based on when you estimate that market or performance criteria is going to be met. So if you estimate that in 4 years, you think the company is going to meet that fair value target, that's your service period, the 4 years implicit in the arrangement. For both service periods and forfeitures, you're going to go through and make an initial estimate of the period or the forfeiture amount and then re-estimate as necessary. So initially, if you determine that performance target is going to be met in 5 years, that would be your initial service period. If at the end of 1 year you estimate it's now going to be 6 years, you would change the service period to 6 years. Likewise, forfeitures, if you estimate 80% of the awards are going to be settled, that's going to be your initial forfeiture estimate, and you're going to base your compensation based on 80% of the total awards being made. So again, if you get to the end of the first year, you change your forfeiture and you estimate now 90% of them are going to be settled. Then you go through and change your compensation costs equal to 90%. And you're going to go through and make those estimate changes annually as you recalculate those periods. And then finally, the cost, typically you're going to recognize on a straight line basis over the service period, but there are some other methods possible. You can do the benefit per years of service approach, or a graded vesting, or a number of other bases. So graded vesting would be maybe where you vest 40% in year 1, 40% in year 2, and then 20% in year 3. So you could recognize your cost 40% in year 1, 40% in year 2, and then 20% in year 3. So you can see there's a lot of potential for different strategies by modifying the service periods and the other terms of the comp agreement, and you can tailor your agreements to drive performance, drive increased company value, drive retention. So whatever you're trying to accomplish, you can sort of modify the agreements to try and accomplish your goals. And then just sort of a catch-all for some of the other accounting requirements. So under commissions, they're going to be recorded when earned. So typical loan officer compensation, a loan closes, they've earned their commission, even though typically you're not going to pay it till the 15th of the following month. So you're going to accrue it in the month when that loan closes. Normal annual bonuses, so if it's your habit to pay bonuses on an annual basis, you should probably accrue an estimated amount ratably over the course of the year and adjust your estimates as you go along throughout the year. Retention bonuses, so we talked about that being one strategy. So if you make a retention bonus contingent on rendering future services, then you're going to expense in a systematic and rational basis over the period future services are rendered. So, we talked about the graded vesting. You can make it where, you don't get anything until you stay 5 years, and then it's 100%. So in that situation, you could use the graded vesting where you recognize everything in the 5th year, or it might make more sense to use that straight line methodology and recognize it over a 5-year period. So that when you're designing your plan, let's talk a little bit about either or conditions and conditions. So if you're doing some sort of either or condition where the agreement is written, if you meet this criteria or this other criteria, then you vest, you're going to do your service period over the shortest period of those two conditions. So in either or, whatever you estimate the shortest service period to be, and you're going to recognize your compensation costs over that period. Now, if you have an and condition where you must meet this condition and an additional second condition or third condition, then you're going to look to what the longest conditional period would be and use that service period as your period. So it's going to be whatever the longest of whatever conditions and conditions you included in the agreement, and recognize your compensation cost over that period. And then finally, to the extent you're going back and making modifications to the agreement, typically it's going to be treated as a new agreement. You're going to recalculate value, and any incremental additional compensation cost is going to be recognized as a compensation adjustment running through the P&L in the current year. So that's some of the basics of accounting as it relates to deferred compensation plans. We're going to go into our second poll question now. So you'll see that on the screen in just a minute. And we'll give you a few minutes to answer the question there. Okay, I think most everybody answered that. And with that, I'm going to turn it over to Jared, and he's going to talk about some of the tax implications of different plans.
All right, thanks, Keith. So if the accounting treatment wasn't exciting enough for you, wait until we start talking about the tax treatment. That's where it can get particularly complicated, and so I'm going to do my best to summarize some of the key tax provisions that govern deferred comp plans. So first of all, just to kind of piggyback off what Keith was talking about from a GAAP perspective, I thought I would just, in general terms, kind of talk about what the tax treatment would be to the employer for qualified plans and non-qualified plans. So for a qualified plan, this would be your typical 401k type plan or other qualified retirement plan, pension plan, etc. From a GAAP perspective, typically you're accruing that as in the period in which you for the period in which you intend to fund. So, for example, if you're plan to fund the plan for 2015, it's going to be accruable in that year. And from a tax perspective, you're typically going to get that deduction on your 2015 tax return as well, as long as the plan is funded by the time you file that tax return, or I should, to be more accurate, by the extended due date of the tax return. So that's, and I think that's what I basically outlined here for your qualified plans. One exception to that would potentially be an ISO, because an incentive stock option may never result in a deduction. That's a special stock option that has special tax rules, and if those criteria under the tax code are met, then there's never any taxable compensation to the employee, and the employer will never be entitled to a deduction. But I say here the only time that the employer would get a deduction is if those specific criteria that I'm talking about, or in other words, a disqualifying disposition of the stock occurs. So for non-qualified plans, and the reason I really point out the qualified plan treatment is there's a substantial difference in the benefit to the employer, at least for non-qualified plans. For a non-qualified plan, you're not going to get the deduction until that the taxable year that the employee receives the income or compensation the compensation that's subject to income tax. So, for example, if you had a non-qualified plan that called for a $50,000 payment to be made 5 years from now, from a GAAP perspective, they may recognize that over the service period, and they would record an expense at that time. But from a tax perspective, you're not going to be able to take that deduction until that 5th year when the $50,000 payment is made. And I say here it could occur when the employee receives a payment, vests in the property, or exercises an option or right. So it really just depends on what that payment is. If it's cash, if it's stock, if it's some other type of property, if it's an option, that will determine when the employee is deemed to have received payment, and therefore when the employer is entitled to the deduction. So from the employee side, the benefit here is that under both qualified plans and non-qualified plans, the employee has the ability to defer the tax on the amount that is deferred in the plan. One caveat here when I say non-qualified plans, I'm talking about non-qualified plans that meet the criteria under Section 409 Cap A, which I'll talk about here in a minute. So if you have a non-qualified plan that does not meet those criteria, there's actually significant tax consequences to that, and again, I'll go through that here shortly. So for qualified plans, again, the employee is going to be able to defer the tax. Couple of exceptions here. Obviously, if you have Roth retirement plans, most people are familiar with those, and if you have a Roth retirement plan, you're using after-tax dollars rather than pre-tax dollars to fund that plan. And then I say potentially ISOs here. Again, if the only way that you can have a taxable event for an employee with respect to an ISO is if they have a disqualifying disposition of the stock at some point in time. Again, I don't want to go into too much detail there, but just a couple of exceptions in the qualified plan. Non-qualified plans, again, the employee is able to defer the tax, use pre-tax dollars to fund the plan, and the property is not considered to be received until, again, payment, vesting, or exercise depending on that plan. So that was just to kind of briefly summarize some of the similarities and differences between the GAAP treatment and the tax treatment to both the employee and both the employer and the employee. So now I want to get into kind of the heavy lifting section here on the tax treatment of deferred comp plans. There's really two main provisions of the tax code that discuss deferred comp plans. One has been around for quite a while and was really the standard that was in place, and that's constructive receipt. So constructive receipt has been around for a while, and what it basically says is that once the employee has an unconditional right to the income, and that's not subject to any substantial limitations or restrictions, then they have, whether they have physically received that payment or not, they're considered to have constructively received it. And at that point in time is when it's taxable to them. So a lot of times where we see this with our mortgage clients is with commissions. An employee may have earned a commission at some point in time, and they may have asked their employer, hey, don't pay me that commission right now. I don't want to pay tax on it this year. Can you pay it to me next year? But if the employee or the loan officer has an unconditional right to that income, if they can call up the company at any time and request payment, then it's taxable to them at that time. The employee cannot just simply say, hey, I want to defer it off a year and not receive payment and therefore defer the tax. So from a company perspective, the risk is that that income is not being properly reported in the W-2s because that's where, at that point in time, is when it should be included. So if you calculate commissions on a monthly basis, for example, and you calculate it for August and pay, it should be paid relatively soon after the calculation is made, and that commission is again, they have an unconditional right to that commission. At that point in time is when it should be included in payroll, the proper withholding should occur, all those types of things. So, what's the risk if this unconditional right exists and it's not being reported properly? Well, to the employer, there's potential penalties for not properly withholding, because again, once it's taxable or an unconditional right of income to the employee and taxable to them, it should be included in wages, and regular holding should occur. For the employee, the potential penalty is that they haven't properly reported all of the income and paid all the taxes on their return. So again, this constructive receipt doctrine has been around for a long time, and so what you want to be aware of is if you have a commission or bonus or other sort of formula where they're able to earn it in one period but it gets paid in another, this constructive receipt might come into place, and you want to be careful both from an employer and employee perspective that you're not underreporting. So that's constructive receipt. Again, been around a while, and as taxpayers tend to do, they were getting very creative and trying to avoid the constructive receipt issue. And so the IRS came in 2000, or I should say Treasury came in, Congress came in 2004 and issued some new regulations under Section 409 Cap A of the Internal Revenue Code. And 409 Cap A speaks specifically to non-qualified deferred comp plans. And what 409 was really designed to do was to try and clarify or strengthen the documentation behind what was already in place in the constructive receipt doctrine. So as you can see there, 409 Cap A applies to any arrangement where a service provider, i.e. an employee, has a legally binding right during a taxable year to compensation that under its terms is or may be payable to the service provider in a later year. So in 409 Cap A, we're not dealing necessarily with W-2 reporting issues or not properly withholding. We're simply talking about year over year. So if income is properly earned, or the employee has a legally binding right to that income in, say, 2015, but that income isn't paid until 2016 or later, then we have a deferred comp arrangement, and 409 Cap A is applicable. And I'm going to go into much more detail about 409 Cap A and some of the provisions of 409 Cap A here in a minute. That last bullet point there are significant negative tax consequences to the employee under this, including an additional tax and penalty, and I'll go into more detail about that in a later slide. Really, the only negative potential consequence to the employer under 409 Cap A is that there is a reporting requirement on the W-2 if 409 Cap A is violated in some way. The employer is required to report certain information on the employee's W-2 when that occurs. And if that's not done, obviously the employer can be subject to penalties at that point. So I think first, to understand 409 Cap A, it helps to understand what doesn't fall under 409 Cap A. So here's some of the most common exceptions. Obviously, qualified plans do not fall under 409 Cap A. They have their own section of the Internal Revenue Code that governs the treatment of those plans. Short-term deferrals. This is a strategy or a provision of the 409 Cap A rules that is probably most commonly used. I made reference to it earlier when I was talking about strategies, but If payment is received when there's no longer subject, or when it's no longer subject to a substantial risk of forfeiture, so there's no limitation or restriction on the payment, as long as payment is received on or before the 15th day of the third month following the taxable year, that's considered a short-term deferral, and you're not under 409 Cap A. So this is why often we'll encourage our clients to make sure that any accrued compensation at the end of one calendar year or fiscal year is paid by the 15th day of the third month of the following year. So if you're a calendar year taxpayer, for example, if you have payroll, commissions, bonuses, whatever accrued because they were earned in 2015, as long as those get paid by March 15th of 2016, you're not going to fall under 409 Cap A because it's considered a short-term deferral. A couple other ones I don't want to necessarily go into too much detail here, but separation pay, depending on the type of separation pay, separation from service is what we're talking about here, those may or may not fall under 409 Cap A. Same thing with stock rights. Stock options or SARs are typically exempt from 409 Cap A as long as the stock right exception applies. There's 3 or 4 criteria that we'd have to look at to determine whether or not that exception applies. If it does, then your stock options and SARs would not fall under 409 Cap A. And then you've got grandfather plans. So these are plans that were created before the effective date of 409 Cap A, which was October 3rd of 2014. And as long as there's no material modifications of the plans, you can most likely fall outside of 409 Cap A. I'm going to get a little water here. So those are your basic exceptions. Now let's talk about some of the requirements of 409 Cap A. So what 409 Cap A basically says is it has a list of very stringent rules. The regs in this area, I think, are over 150 pages long. So we're talking about some very detailed, stringent, complex rules that must be followed in order for you to not have a plan that fails 409 Cap A and therefore results in these negative tax consequences to the employee. One of those requirements, and obviously on this webinar I don't have time to cover all 150 pages of the regs, so I'm going to really try and highlight some of the key points. One of those key points is that the plan must be written. So to comply with 409 Cap A, the non-qualified deferred comp plan must be in writing. It must include all the material terms of the plan, and it must contain certain specified terms and provisions as I outlined here below. So again, must be a written plan. If it's not in writing, then it's potentially subject to 409 Cap A unless you can get out through one of those exceptions such as the short-term deferral or it's a qualified plan or one of the other exceptions. If it doesn't meet any of those exceptions and it's not in writing, it's going to be subject to 409 Cap A and could potentially result in some negative consequences to the employee. So what else must be included in this written plan? You must talk about deferral elections. So it has to specify the conditions under which an initial or any subsequent elections to defer income are made. So again, that just must be spelled out in the document. There's a 6-month delay rule for specified employees. Specified employees is a defined term and it only applies to public companies, so I'm not going to go into too much detail here. Any plan amendments. Any amendments to the material terms of the plan, including an increase to the compensation deferred, must be written into the plan document. Payment provisions. So any discussion around distributions from the plan must be included, including the time and form of payment. And I'll go into more detail here in a minute on that. And then acceleration of payments. Generally, it's not required to be addressed in the plan unless the regulations specifically require you to include some language there. But in general, I would say that the 409 Cap A rules will not permit you to accelerate the payment or delay the payment. There's very specific situations, and they're pretty rare as to when you can do that. So whatever time and form you designate in the agreement is pretty much got to be set in stone. And then while there's not any necessarily requirement to include other provisions, there's a variety of other things that you would probably most likely want to include in the plan document. And so, just certain things that you'd want to consider and make sure you include. So now I want to talk about two of the specific things that you must include in the plan document, and those are deferral elections and then distributions. So I'm going to try and cover these pretty quickly here. But so the deferral election rules. The general rule says that an election to defer compensation must be made in the calendar year before the year in which the attributable services are rendered. This is often referred to as the year before the year rule. So I have an example here. If you're planning to, or if an employee is planning to defer some of the compensation that they're going to earn for services that they're going to render in year 2, they have to make that deferral election no later than December 31st of year 1. So no, you can't like get halfway through the year and then decide, hey, I want to defer some of my compensation. It's too late at that point. And then in order to have a valid deferral election, there's really 3 requirements that must be met. One is the deferred compensation the deferred compensation must be deferred beyond the date it would otherwise be paid. So again, earned in 1 year, paid in a subsequent year. You must designate the time and form of payment, and I'll talk a little bit more about what time and form of payment means here in a second. And it must be irrevocable, which means it can't be changed. So there's certain limited exceptions to that within the regs, but in general, if you make an election, say December 31st of year 1, to defer 10% of your income that you're going to earn in year 2, that's going to be set in stone. So you get halfway through year 2, there's not going to be any opportunity for that employee to say, never mind, I don't want to defer that 10% anymore. Some exceptions to the general rule. Performance-based compensation, I want to be careful about this one. That's a very well-defined term in the code. It's a pretty stringent and narrow definition of what performance-based compensation is, so I don't want you to expand that broadly and think it can apply to lots of different things. But if it does meet the requirements of performance-based compensation, and you can actually defer up to 6 months before the end of the performance period. So this is an exception that would allow you to get basically 6 months into the year and then decide, hey, I want to defer some of my performance-based comp. If you're a newly eligible participant in the plan, you have 30 days from when you first become eligible to participate to make an election to defer. There's some language in there about forfeitable rights. So if you had a right to certain income that was forfeitable, and once it becomes legal, once you have a legally binding right to that compensation, then you have 30 days from that date to make a deferral election if you want to. And then the other most common one is what they call hardwired deferral elections. So that's where basically the employer is forcing a deferral in some way. Then any time before the participant has a legally binding right to that compensation, they can make a deferral election. And then there's other various exceptions that I'm not going to go into at this time. Okay, distribution rules. So we talked about the deferral. Once you have deferred that compensation, there's certain specific rules that talk about when you're able to and how you're able to receive distributions from the plan. So this goes to that time and form of payment that I've made reference to in a couple of previous slides. The rules require that these be designated when the deferral election is made. So oftentimes, or it's actually required, that the written document is going to talk about time and form of payment. And so obviously when a deferral election is made, if the agreement speaks to it, you've designated it at that time. So what does time mean? Well, 409-CAP-A provides for permissible payment events or triggers. So those are listed there. Separation from service, disability, death, specified payment date or fixed schedule of payments, change in ownership or effective control of the company, an unforeseeable emergency, and then a substantial risk of forfeiture. I've kind of listed off to the right of each of those, how that's going to be determined. So like separation from service, for example, employers used to play games under the constructive receipt doctrine where an employee would come and say, well, why don't I quit today and you can rehire me tomorrow, or I'll quit this company but you can rehire me over here at this company. So that's where I say all facts and circumstances are going to be considered. The IRS would look at an arrangement like that and say, you never really separated from service because, you know, quitting one day and working for the same company or a subsidiary or related company the next really doesn't pass muster. So you got to kind of be careful about what separation of service means. Disability is specifically defined in the code. Death, I don't know that there's any other way to define death except death, so that's actually the one that doesn't have any definition around it in the code. Specified payment date or fixed schedule of payments. I say there the dates must be non-discretionary and objectively determinable. So I think some of the examples that they use in the regs or in some of the other guidance is you can't say, hey, I want to receive the deferred comp when my first kid goes to college, because that's not an objectively determinable date. Your kid may or may not go to college, so they're not going to allow you to just throw that date out there. But something like, hey, I want to receive payment when I turn on my 60th birthday, you know, that would be something that would work. Change in ownership, and then, you know, a fixed schedule of payments, you can obviously just map it out where, hey, you know, there's $50,000, I'm going to put in this deferred comp plan, it'll be payable to you as long as you stay for 5 years, and then after 5 years, we're going to pay you $10,000 a year for the next 5 years. That would be a fixed schedule that would work under the 409 Cap A rules. Change in ownership or effective control of the company, again, there's specific requirements about, those are defined terms in 409 Cap A. An unforeseeable emergency, it's got to come from an extraordinary or unforeseeable circumstance, and there's a lot more criteria in the rules about, you know, does this qualify or not. And this is actually the one trigger event where the company and the employee essentially have to agree. So if the employee goes to the company and says, hey, I've had an unforeseeable event, the employer has the option to decide whether or not that is an unforeseeable event under the terms of the agreement. So a little bit of flexibility there. And then a lapse of substantial risk of forfeiture. So again, this would just be where any restriction or limitation on receipt of that compensation, again, you can kind of wait until that point in time and then have some sort of payment schedule or a fixed payment date or something to allow you to still fall under the rules of 409 Cap A. So those are the timing triggers. Those are basically the permittable events or triggers that are allowed for payment of any deferred compensation under a non-qualified deferred comp plan. If your plan doesn't call for one of these specific payment events or triggers, then you fall out of qualifying or meeting the tests of 409 Cap A, and the terrible tax consequences to the employee would kick in. Form is the other one. Form is pretty straightforward. It just refers to the number of payments that are to be made. So examples include a lump sum payment, installment payments, annuity payments. As long as that's all spelled out in the agreement, you're good to go. Running out of time, but I just want to quickly, on this last slide, talk about those negative tax consequences that I've referred to several times to the employee. So what's interesting about 409 Cap A is that there's not really any significant negative tax consequences to the employer. They're really going after the employee here. So what happens to the employee if there's a planned failure under 409 Cap A? One is the income inclusion. So if in the year that there's a failure, the employee is required to take any vested deferred amounts for that year and all prior years and include it in income. And the employer is required to report that on the employee's W-2. So that would be pretty negative if all of a sudden, you weren't expecting to pay taxes on this income for several years, and all of a sudden you got to accelerate that and pay it now. Especially if the plan doesn't call for a payment, and there's no payment that's going to be made to help pay those taxes. In addition to that, the IRS is going to assess what they call the additional 20% tax. So any amounts that are includable in income in the current year because of a planned failure is not only subject to the regular income tax, but an additional 20% tax on top of that. So if your employee is in the 40% tax bracket they could potentially be paying 60% tax on this income. And then finally, there's a premium interest tax. This is really a penalty that's imposed. It's calculated using the underpayment rate plus 1%, and it's calculated on any underpayments in prior years. So if you have amounts in the current year, you're probably okay, but if you have to all of a sudden pick up amounts that were deferred in prior years, they're going to calculate this underpayment interest tax and tack that on as well. So as you can see, the consequences for having plan failures under 409 Cap A are very severe, and it's one reason why we're encouraging our clients to really pay attention to these rules and make sure that they have dotted their I's and crossed their T's when it comes to making sure that all of their plans are in compliance with these 409 Cap A rules. So with that, I think we're going to launch our final poll question. Should be coming up now, and we'll give you 20 seconds or so to answer that. Hey, great. Looks like most of you have been able to answer that question. So we appreciate you sticking with us. Covered a lot of material today on deferred comp plans. There's a lot more that we didn't cover, but wanted to at least introduce these concepts to you. Again, to qualify for CPE, you had to answer those poll questions, and you also need to stay on for the survey at the end. So don't quite hang up on us yet if you want to qualify for the CPE. But at this time, we'll go ahead and address any questions. No questions.
And we will be mailing out the slide deck to all the attendees, and we'll also be posting the recording of the webinar on our website. So if you have any employees that you'd like to have listen to it, you can go onto the website and have them listen to it again. So.
Okay. There's no questions. Obviously, if you have questions after the presentation, feel free to reach out to Keith or myself. Or others that you work with here at Richey May. We'd be happy to try and address those for you. If not, then I think we'll go ahead and launch the survey. And again, appreciate your time today, and hope you have a great rest of your day.